Hi, welcome to this brief session on market outlook and investment strategy. Since April 2020, markets are in a bull run globally. There are very few exceptions. India is one of the best performing large markets. Since the lows of March 2020, Nifty is up by more than 135%. Last 1 year return from Nifty is around 40%, and 2 year return is more than 50%. The broader market, mid and small caps, have outperformed Nifty and the large caps. So these are very impressive returns, rare returns. Now there is a near consensus that valuations are rich in the market. In India, particularly, our valuations vis-a-vis emerging markets peers is at an all-time high. So there is a near consensus. Even bulls concede the fact that valuations are rich, and even central banks like RBI have been warning about excessive valuations of stocks. So when the valuations are very rich, it would be realistic to expect only modest returns from stocks for the next 1 year. Long run, of course, prospects are extremely bright. For the next 1 year, it would be realistic to expect only modest returns. So when we prepare ourselves for modest returns, it would be sensible to tweak the investment strategy, to make some investments changes in the investment strategy so that we can maximize the returns and minimize the risk. So in this video, I will share with you some 5 suggestions which can be used for making some changes in your portfolio and tweaking your investment strategy. Number 1, diversify your portfolio. When I talk about diversification now, I'm not talking about diversification between sectors and industries in India. We are already doing that. But when I'm talking about diversification now, I'm talking about diversification across geographies, diversification across currencies, diversification across assets. Now, India, as I said in the beginning, valuations are very high. For example, our Nifty PE is now, forward PE is around 24. Whereas in US, the S&P 500 PE is just about 20. So even in the developed markets, the valuations are relatively lower than ours. Therefore, if there is a market correction, it is quite possible that emerging markets like India may experience a sharper pullback when compared to the developed markets. So it will make sense to invest globally. And how can you invest globally? Now it is possible to invest in US stocks, for instance, through your broker. That can be done. A simpler alternative would be to invest in global markets like the US through the mutual fund route. Just as we invest in mutual funds investing in India, you can invest in Indian fund houses, mutual funds, investing in developed markets like the US. So that would be a major suggestion, diversification across geographies. Secondly, it would be desirable to increase the exposure to gold during the next 1 year, because inflation is rising globally. In India also, inflation is rising. During times of inflation, gold would be, historically our experience is that gold is a safe bet. Also, rupee is expected to depreciate by 5 to 7% during the next 1 year. That will also enable gold to appreciate. So there are many investors whose exposure to gold is very low, less than 5%. Such investors can think of increasing the exposure to gold to 5% or even more. preferably through sovereign gold bonds or through exchange traded funds. Exchange traded funds are very liquid and the transaction costs are very, very negligible. A third suggestion would be to avoid stocks in bubble territory. When we talk about rich valuations in India, we have to distinguish between fair valuations in some segments and excessive, irrational valuations in many other segments. For instance, in the case of the newly listed digital stocks, consumer facing digital stocks, where the IPOs have been oversubscribed many times, well, there is a sort of a fad in these stocks. Of course, some of these stocks may do exceedingly well in future, no doubt about that. But you cannot justify valuations of 1000 PE, 1500 PE for some of these stocks. I remember in 2000, some of the IT stocks had PEs of 100, 150. And when the markets crashed, these high valuations also crashed. Therefore, it would be irrational to invest in these futuristic stocks, even though they have very good prospects, at the irrational valuations of 700, 1000, 1500 PE. It would be sensible to avoid that. When there is a market correction, these stocks will be available at much lower valuations. At the same time, there are stocks, domestic stocks, conventional stocks, traditional stocks with reasonable valuations and very good earnings visibility. Investors should consider that. My fourth suggestion would be to prefer large caps to small and mid caps. We know in a bull market, the broader market outperforms. The mid and small caps outperform. In India, during the last 2 years, the mid and small caps have outperformed. But the trend will reverse when there is a consolidation in the market or a correction followed by a consolidation in the market. So going forward, I'm talking about a potent possibility of correction in the next few months. Since April 2020, markets have been a one-way street. Markets cannot continue to be a one-way street for long. Therefore, when the market corrects, the small and mid caps will correct more than proportionately. Therefore, prefer large caps to mid and small caps, but continue investing in mid and small caps through the systematic investment plans in mutual funds. Even within large caps, it would be better to go for large caps with good earnings visibility in performing sectors like IT, financials, healthcare, construction related segments. Earnings visibility is good and valuations also are not very rich or excessive. My last point would be to request investors to continue with systematic investment plans. Our experience is that it is impossible to time the market. And if our objective is to participate in the wealth creation through the stock market, investors should remain invested. Investors should continue investment. So don't stop your SIPs. Continue investing through the systematic investment route. Therefore, in brief, the long-term prospects for India are very good. By 2030, India is likely to be a $7 trillion economy. Market cap also can be around 7 trillion or more than 7 trillion. And the stock market indices can multiply a few times from here. So long-term prospects are very good, but in the short run, there will be challenges. So investors should formulate their investment strategy considering these challenges. Thank you.